Hello and welcome. You tune into Rush Hour with me, Ankita Saxena. Well, after much anticipation and speculation, j.p.morgan is all set to include Indian government bonds in the emerging market bond index. According to the note, it will come into effect from June 2024. The inclusion process will span over 10 months' time, projected to be complete around March 2025, including a percent weightage per month. Now we have with us Sanjeev Sanyal, who's the member of Economic Advisory Council, to discuss more on this. Welcome to ET Now, Sanjeev. Sanjeev, J.P. Morgan has added India to their bond index. What are your first thoughts on it, and what changes can we see for India?
Well, this has been in the works for some time, so it's not a surprise. The government and these bond index folks have been working together on this for quite some time. You can't do something like this overnight. So there were many iterations and talks over the last few years. And so it's now come to fruition. And you can see that we are now going to be included in this index, and the weightage will eventually go up to something like 10%. So in that sense, it paves the way for some 24 billion odd from just this one index coming through into the Indian bond market over the next 12 to 18 months. But also do remember that there are several other bond indices as well. And now that j.p. Morgan, which is one of the bigger ones, has included us, then it is very likely that some of the others will do so as well. And the impact of that will be that up to something like $40 billion worth of passively managed bond money, fixed income money, will come into the Indian financial market. So that's good. It's a source of capital. It's relatively more stable than actively managed money. And it tends to, the impact of that is that it brings in cheaper capital into our economy. So it, in that sense, lowers the cost of capital. And since it specifically invests into government bonds, it also means that the government's own yields will, over a period of time, come down below what they would have otherwise been. It's very difficult to put a number to this because it's difficult to work out the what would have it been otherwise, but it can be quite significant.
Sanjeev, but do you think that the Indian bond market is deep and mature enough to deal with this sort of an inclusion, or will there be any reforms needed to be introduced to improve the bond market further?
So we are not in the 90s or 2000s anymore. The Indian government bond market is reasonably deep and mature. It's gone through many iterations, shocks, etc. over the last several years, and has held up reasonably well. Of course, if some extra things need to be done, we'll do it. But I don't think that will be needed will be some major structural change. Incremental changes we keep making as a matter of course, and if something is needed, we'll do it.
Right, Sanjeev, also this inclusion will give the government an option to manage the deficit better, given that they can also now raise funds from foreign investors. Is this interpretation correct?
Not in the way you've stated it. So the way you're making it out to be that we take some part of the fiscal deficit and we go out to foreign investors and ask for money, specifically that's not how it works. We are issuing bonds into one market. All that is, and that market already is open to foreign investors, and there are already foreign investors going investing in these bond markets. All that is happening is that j.p. Morgan, which is a very large fund manager, has put us in an index which is used to benchmark by a large number of money managers around the world. And since they manage their money based on this index, the fact that we are in this index means that they will begin to because of this benchmark, put some of their money into our bonds. All these people could have done it even earlier. All that is happening is that because we are in this index and they follow this index, they are in some ways, compelled to make this passive investment as part of that. So that is basically what is happening. And yes, to the extent that there are extra people willing to buy our bonds, it makes the government it easier for the government to sell these bonds into the market in general. So it's the general market that sees an inflow of certain amount of capital, that some part of it is then sucked up by the government.
Right. Also, do you expect a significant impact on the yields owing to the inflow, or will the impact be gradual as per your understanding?
So there'll be some impact, as I mentioned, that it just means that it will be lower than what it would have otherwise been. But as I said, putting a number to it is a fiendishly difficult thing. Now, I used to work in financial markets, and let me tell you that analysts will not be able to put a hard number on this, and they shouldn't even try. What will happen, however, it will create a new pool of new investors. It will create more liquidity. It will mean that we are a part of the global story in multiple ways, not just for the narrow aspect of global bond index, but you are part of the global conversation and in terms of fund management and money allocation. So all of this adds up in the end to make us a part of the global financial system. And of course, India is a country where historically capital has been expensive. So what this does is, to some extent, it lowers that cost of capital.
Right, more liquidity and, of course, lowers the cost of capital. But do you expect the flows could lead to, a rupee appreciation meaningfully?
My point still stands, which is that the Reserve Bank is now quite conversant with these kinds of flows. We are now a large economy, and large amounts of capital go in and out of the country all the time. And we have a well-established and successful way of managing the foreign exchange reserves, established over decades now. So, for a country which has got more than $600 billion worth of reserves, an extra 24 billion here or there is not, game-changing. It is a good addition to the ecosystem of capital sources, that's all. And so it's a positive. And it certainly doesn't require the Reserve Bank to change the way it manages the exchange rate. That's the point I'm making. The current system is more than good enough, which is that the Reserve Bank basically allows the rupee to find its own level, but leans against the wind, either up or down, if there is a sharp movement. And we have more than adequate foreign exchange reserves to be able to do it in either direction.
All right, Sanjeev, thank you so much for joining us. Thank you so much for your time.